Welcome to the Deep Dive. Today, we're looking at Warren Buffett. Not just his success, but maybe why his approach had to evolve.
Exactly. Because back in, 2004, he was really unique in the Forbes top 5.
Right. The only one whose fortune, that massive $42.9 billion, came purely from the stock market. His genius seems to be, well, discipline.
Oh, absolutely. And it started really young. You can see this clear path, fascinated by numbers early on, reading stock books when he was just 8.
8 years old, wow.
Yeah, and then marking the board at his dad's brokerage at 11. But the big moment, the real turning point, was reading Benjamin Graham's The Intelligent Investor.
That book was key.
It was everything. It, directly led him to Columbia Business School. He wanted to study under Graham himself.
And that mentorship, that really kicked things off. So 1956, he starts his own limited partnership.
With barely any of his own money, just $100 initially.
And sets this incredibly bold goal. Beat the Dow Jones average by 10 percentage points every year.
Which sounds almost impossible. But he didn't just meet it. Over 13 years, he averaged 29.5% compounded returns annually.
Think about that, 29.5% a year. And crucially, he never had a single losing year in that entire run.
Just incredible consistency. And that track record, it was built squarely on Graham's ideas, finding value where others didn't see it.
Like that American Express story, the salad oil scandal.
Perfect example. Early 1960s, big scandal hits, Amex stock tanks. Goes from $65 down to $35 a share. Panic everywhere.
So what does Buffett do?
He jumps in, big time. He commits 40% of the partnership's entire capital, $13 million back then, into American Express stock.
40% on one stock during a scandal. That sounds incredibly risky. How did he justify that?
Because he wasn't looking at the scandal, not really. He was looking at the business. American Express's brand, its travel network that hadn't gone away, the value was still there.
So the market was panicking, but the company itself was sound.
Exactly. It was what he called a certainty at a discount. He was certain about the long-term business, and the price was temporarily cheap.
And it paid off.
Hugely. The shares tripled. It proved his point. Conviction plus solid valuation works.
Okay, so fast forward. 1969, the partnership ends. His share, $25 million. Enough to get control of a little textile company called Berkshire Hathaway?
And the rest, as they say, is history. The numbers for Berkshire are just mind-blowing. From 1964 to 2003, the book value per share,
which is basically the company's net worth on paper.
Right. It went from $19 to over $50,000 per share.
That's a compound annual growth rate of 22.2%.
Compare that to the S&P 500 over the same period, about 10.4%. He absolutely crushed the market.
Which brings us to a key question. If those principles worked so incredibly well for so long, why did we start seeing a shift? People talked about his buyer's strike starting in the late 90s.
Yeah, he became much less active buying common stocks, and it ties right back into that core philosophy.
Buying certainties at a discount.
Exactly. Certainties for him meant businesses with really predictable economics. Think insurance, utilities, maybe strong consumer brands like Coke, stuff he understood deeply.
The whole circle of competence idea, stick to what you know.
But there's the rub. That discipline created a dilemma, especially as markets got frothier.
How so?
Well, the companies he understood, the predictable ones, they just weren't selling at a discount anymore. The market recognized their certainty too, Their prices were high.
Okay, so the certainties weren't cheap.
Right. And the newer industries, things like tech in the late 90s bubble, or maybe complex biotech later on, they didn't have the long track record of predictable economics he needed. They were outside his circle, or at least didn't offer that certainty.
So his own rules kind of forced him to the sidelines for buying stocks.
Pretty much, which explains the major shift in strategy we saw.
Moving towards buying entire businesses outright.
Precisely. Instead of buying shares, pieces of paper, he started using Berkshire's massive capital to buy whole companies, control the entire operation.
Why is owning the whole thing better for him?
Control. It eliminates what he called the angst of being a passive shareholder, dealing with boards, executive pay packages he might disagree with, how companies spend their capital.
Right, those corporate governance headaches. If you own the company, you set the rules.
You remove that friction. You control the capital allocation directly.
Now, obviously, buying whole companies isn't really an option for, most individual investors listening.
Not unless you have billions lying around.
Right. So the source material kind of leaves you with two paths, doesn't it?
Yeah. One, you could simply invest in Berkshire Hathaway itself, sort of piggybacking on his decision.
Or the second, much harder path.
Adopt the principles. But that means doing the hard work yourself. You have to expand your own circle of competence. You need to really study and understand the business models of today's economy, the new economy landscapes.
Even if they lack that long-term certainty he always looked for.
That's the challenge. The principles value, certainty, competence, they still apply, but you have to apply them to a different playing field. It requires new knowledge.
And one last thing, something really striking about Buffett is his candor. He's famous for telling shareholders everything he'd want to know if their positions were reversed.
Just remarkable transparency. His annual letters are legendary for it.
So it leaves us with a thought for you, the listener. What level of candor, what level of transparency do you actually demand from the investments you make, or even the sources of information you rely on? Something to really chew on.
Welcome to the deep dive. Look, Warren Buffett, his track record, it's, well, legendary. 4 decades plus.
Unmatched, really.
Exactly. So today, we're doing a shortcut. We're diving into the 4 key figures who really shaped his thinking, his financial education, both formal and informal.
Yeah, it's like uncovering the intellectual DNA.
Yeah.
His approach seems simple on the surface, but it's built on these core philosophies he absorbed.
And those 4 are?
Benjamin Graham, Philip Fisher, John Burr Williams, and you absolutely can't forget Charles Munger.
Okay, let's start with the bedrock. Benjamin Graham, the dean of financial analysis, right? Security analysis, the intelligent investor. These are like the Bibles of value investing.
Absolutely, foundational texts. And Graham's biggest contribution, arguably, is the margin of safety.
Explain that a bit. What is the margin of safety?
It's basically a buffer. It exists when you buy a security for significantly less than its real intrinsic value. It's your protection against being wrong.
And his famous rules.
Oh, yeah. Rule number 1,
Yeah.
don't lose. And rule number 2,
Don't forget rule number 1. Love it. Pure discipline.
total discipline.
Yeah.
He focused on stocks that were just, unjustifiably hype.
Yeah.
Could be selling for less than 2/3 of their net assets, or with really low PE ratios, capitalizing on market fear and greed, basically.
So, pure numbers, hard data. But Buffett didn't just stick with that, did he?
No, and that's where it gets interesting. He realized, I think, that numbers alone weren't enough. You needed to assess the quality of the business. And that leads us to Philip Fisher.
Okay, wait. Graham is all quantitative, hard numbers. Fisher sounds different, more qualitative. How did Buffett blend those? Seems like a big leap.
It was a big leap. Fisher pushed him beyond just the balance sheet. His big thing was scuttlebutt.
Scuttlebutt sounds like gossip.
Sort of. But for investing. It means digging deep, talking to everyone, customers, competitors, suppliers, even former employees, getting the real story behind the numbers.
Okay. Investigating the actual business.
Exactly. Fisher looked for companies with great growth potential, strong R&D, good sales teams, solid profit margins. He believed in owning just a few outstanding companies, not a whole basket of average ones.
Got it. So from Graham's don't lose money discipline to Fisher's find a truly fantastic business. That's quite the evolution.
And then you need to figure out what that fantastic business is actually worth.
Yeah.
Which brings us back to calculation. And John Burr Williams.
He provided the math model.
Yeah, the dividend discount model, or you could think of it as discounted cash flow. His idea was simple, really.
Wasn't his quote something about cows and hens?
That's the one. A cow for her milk, a hen for her eggs, and a stock, by heck, for her dividends.
So the value today is just all the future cash it'll generate discounted back.
Precisely. All the cash flows, or dividends, over its lifetime brought back to their present value. Buffett uses this thinking constantly, often with a low discount rate, like the long-term U.S. bond rate, reflecting a desire for certainty.
Okay, Graham for safety, Fisher for quality, Williams for valuation. That brings us to number 4. Charles Munger, Buffett's longtime partner.
Yeah, they met way back in 1959. Munger wasn't so much a teacher in the same way, but more like a catalyst. He really pushed Buffett to evolve beyond just pure Graham.
How so? What was Munger's big influence?
Munger brought this idea of a lattice work of mental models. Thinking across different disciplines, psychology, history, physics, he basically told Buffett, look, buying mediocre businesses just because they're statistically cheap, these cigar butts, as Graham called them, isn't the best long-term game.
Right, he wanted better businesses.
Exactly. Munger famously said, and Buffett adopted this completely, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's Munger's philosophy right there.
So wrapping this up for you listening, Buffett's genius wasn't just one idea. It's this incredible synthesis.
Right. He took Graham's disciplined, quantitative margin of safety framework,
and blended it with Fisher's focus on finding great businesses and Munger's push towards quality, even at a fair price, the qualitative potential.
It's that integration of seemingly different, sometimes even conflicting ideas that's so powerful. Many people are smart, many are disciplined, but integrating like that, that's rare.
Which leaves us with a thought for you. Munger stressed pulling ideas from psychology, history, other fields. So what other areas of knowledge, maybe totally unrelated on the surface, could you integrate into how you make decisions, whether in investing or, well, anywhere else?
Welcome to the Deep Dive. Today we're looking at a truly massive transformation. How Berkshire Hathaway went from, well, basically a failing textile mill.
To the investment powerhouse we know today, and the engine behind that, insurance.
Exactly. But let's set the scene first. 1965, the Buffett partnership takes control, and the original Berkshire Hathaway is in terrible shape.
Yeah, terrible might be an understatement. Stockholders' equity had halved. They'd lost over $10 million just from operations. It was bleeding cash.
But there was this one bright spot almost immediately, right? The stock portfolio.
Oh, absolutely. It was tiny compared to the textile assets, but in the first year alone, it jumped from, what, $2.9 million to $5.4 million.
And just 2 years later, by 67, the return from those investments was 3 times the return of the entire textile division.
And that textile division had 10 times the equity base. It just hammered home the lesson.
Which was?
Textiles were a bad business, a commodity, basically. Fierce foreign competition, needed constant, expensive upgrades just to eke out tiny profits.
Buffett knew this, but he kept it going until 1985.
He did, largely for humanitarian reasons, trying to ease the transition, but it taught him a valuable, if painful, lesson. Corporate turnarounds, they rarely actually work. You can't fix a fundamentally broken business model.
Okay, so that failure kind of forced his hand.
Yeah.
March 1967, Berkshire buys National Indemnity and National Fire and Marine. $8.6 million.
Right.
But wait, if textiles were draining capital, how did buying insurance companies suddenly fix things? What was the magic there?
The magic was something called float. See, insurance companies collect premiums up front from policyholders.
Correct.
That cash doesn't get paid out in claims immediately. So the company holds it, that's the float. And what do they do with it?
They invest it.
Exactly. They invest it in stocks, bonds, whatever, until they actually need it to pay claims. It's like getting a huge, constantly replenished pool of capital, often at zero cost.
Wow. So like an interest-free loan from your customers.
Or sometimes even better than interest-free, as we'll see. And the impact was immediate. Those two companies' portfolios, they grew from about $32 million to nearly $42 million in just 2 years.
Incredible. But just having float isn't enough, right? You
Yeah.
need smart ways to generate good float. Which brings us to Geico.
Ah, Geico! A company Buffett had been fascinated with since his Columbia days. Their model was brilliant in its simplicity.
2 core ideas, right?
Yeah. 1, only insure good drivers, people less likely to crash. 2, sell directly to them, cut out the agents and their commissions, lower costs, lower risk.
So you're essentially borrowing money to float from the safest possible group.
Precisely. But even Geico hit a rough patch. Mid-70s, they loosened their standards, started insuring riskier drivers.
And disaster struck. Stock price collapsed, I read, from $61 down to just $2 a share.
Yep, near bankruptcy. But Buffett never lost faith in that core model. Starting in 76, he poured in, I think it was $45.7 million.
A huge bet at the time.
Massive. But it paid off spectacularly. Geico got its discipline back, and for the next 20 years, they made an underwriting profit premiums exceeded claims and expenses in all but 1 year. That kind of consistency is, well, almost unheard of in insurance.
Okay, fast forward, 1998.
Yeah.
A much bigger move. General Re, or Genre, $16 billion paid in Berkshire stock,
Huge scale shift. Genre is a reinsurer.
meaning they insure other insurance companies.
Correct. So, massive potential for float, but it came with massive problems baked in. Genre's management had been chasing market share, not profit,
How?
by underpricing their policies, basically selling insurance for less than it would likely cost them down the road. Think of it like selling $100 bills for $95 just to get the business.
It sounds unsustainable.
It was, big time. Led to a $1.6 billion underwriting loss in 2000. Then, boom, 9/11 hit, adding another unexpected $1.7 billion loss.
Ouch. So what was the lesson there?
Underwriting discipline is everything. You absolutely must price risk correctly, no exceptions. They had to fix genre, get it back to basics.
And they did.
They did. By 2002, genre was back to making an underwriting profit. It reinforced the whole Berkshire insurance philosophy.
We did.
Insurance is a commodity, sure, but you build a franchise not by being the cheapest, but by being the strongest financially and the most disciplined. You simply refuse to write, as Buffett called them, dumb insurance policies.
Don't chase bad business just for the sake of volume.
Exactly. And the ultimate proof of this comes from Ajit Jain's reinsurance group within National Indemnity.
Okay, this is where it gets really mind-bending for you, the listener. In 2003, that group had a cost to float.
That was negative 3%.
Wait, negative cost? How does that work?
It means they made an underwriting profit of over $1 billion. They brought in so much more in premiums than they paid out in claims and expenses that they were effectively being paid to hold billions of dollars of policyholder money.
So forget zero-cost capital. This is capital that comes with a paycheck attached.
Precisely. While other companies pay interest to banks or bondholders, Berkshire's insurance engine was literally generating cash before even investing the float.
So let's leave you with this thought. What kind of advantage does a company have when its primary source of funding actually pays it interest? Imagine running your business where your loans gave you a rebate. That's the power Berkshire built.
Welcome to the deep dive. Today, we're getting right into Warren Buffett's core investment idea.
That's right.
We're looking at sources that all point to one, well, pretty simple principle, really.
Which is?
That when you buy a stock, you're not just buying, a ticker symbol. You're actually buying a piece of a real business.
Exactly. And the scale here is pretty amazing when you think about it. Berkshire Hathaway, it's this huge, complex company.
Right.
Owns nearly 100 different businesses. I mean, everything from paint and insurance to uniforms, even candy. Super diverse.
Okay.
But here's the kicker. The rules Buffett uses to buy a whole company, they're identical to the ones he uses for buying stock in a public company.
So it's the same checklist.
Pretty much.
Yeah.
He just, prefers owning the whole thing so he can decide where the money goes, the capital allocation.
Okay, let's unpack that owner-investor mindset then. You need some rules, some criteria before you buy any business. What are Buffett's absolute must-haves?
Well, the list is actually remarkably consistent over the years. First, the business has to be simple, something he understands.
Makes sense.
Yeah, and it needs a history of, consistent earnings.
Yeah.
Good long-term prospects are key, too.
Okay, consistent earnings, good future. What else?
A good return on equity, basically. How well it makes profit from the shareholders' money, ideally, with not much debt.
Right.
And, maybe most importantly, honest and competent management. People he trusts.
And you also need an attractive price, right? But isn't that where things got interesting? The big philosophical shift with See's Candy?
Absolutely. See's was pivotal. 1972. He pays $30 million for it.
Which sounds like a lot.
Well, it was 3 times its book value. Now remember, his mentor, Ben Graham, basically taught him to buy companies for, less than they were worth if you sold off all the parts. Cigar butts, he called them.
So paying 3 times book value was a big
huge, a radical departure. He wasn't just buying cheap assets anymore. He was paying up for quality, for future earning power.
And did it pay off?
Massively. Just look at 2003. See's had pre-tax earnings of $59 million in that year alone, more than double what he paid for the whole company decades earlier.
Wow, okay.
And Charlie Munger, his partner, flat out said it. If we hadn't bought See's, we wouldn't have bought Coke. That idea of paying for a brand, for quality, that was the breakthrough.
It changed everything for them.
Completely. Understanding that some businesses like See's could just raise prices year after year without losing customers. That's powerful.
That focus on enduring quality seems tied to management, too. Like the Nebraska Furniture Mart story, Mrs. B.
Exactly. Nebraska Furniture Mart, bought in '83. The founder, Rose Blumkin, what a story. Russian immigrant, worked till she was 104.
104.
Yeah, that's the kind of founder commitment he loves. And her famous line really says it all. If you have the lowest price, customers will find you at the bottom of a river.
Simple, powerful.
Right. Just basic, strong business principles run by someone totally committed. That creates value that lasts.
Okay, so that shows the power in private companies with great owner-managers. How did he translate this quality-first idea to, regular stocks on the market?
He used the exact same thinking. Take Gillette, for example, back in 1989.
The razor company.
Yep, Wall Street kind of thought it was, stagnant, past its prime. But Buffett saw the business differently.
How so?
He saw the razor blade model as almost like an annuity. People keep buying them. So Berkshire invested $600 million.
A big chunk of change.
Yeah, But it was through preferred stock. It
Mm.
gave Berkshire a nice steady income and helped Gillette pay down debt.
So Wall Street saw stagnation, Buffett saw a durable business.
Precisely. And then Gillette launched the sensor razor.
Yep.
Huge success. Their return on equity shot up to 40%.
40. Wow. Double what it was before.
Exactly. Just proved the point. Strong, simple economics, good management. He wasn't betting on some complex turnaround. He bet on a dominant, understandable business.
So wrapping this up, what's the big takeaway for you listening right now? You probably can't buy See's candy outright.
Huh? Probably not. But you absolutely can adopt that same owner's mentality.
How does that work in practice?
Well, you can profit by focusing on businesses that are, relatively simple and understandable. Think about Coca-Cola, razor blades like Gillette, maybe banks like Wells Fargo back in the day. Things you can grasp.
So vet the stock like you're vetting the whole business.
Exactly.
Yeah.
Look at the management, the economics, the long-term picture. Ask yourself, would I want to own this whole company? Because owning shares is owning a piece of the business, not just a lottery ticket.
It really brings us back to that core idea: investing is businesslike. And Buffett often quotes his mentor, Benjamin Graham, on this.
Oh yeah, the famous line, Buffett calls them the 9 most important words ever written about investing.
Which are?
Investing is most intelligent when it is most businesslike.
Simple but profound.
It really is. And maybe that's the final thought for you to mull over. Are you acting like a business owner when you invest? Or are you just sort of holding securities, shuffling pieces of paper?
Something to think about. That's all for this deep dive.
Welcome to the Deep Dive. We've been looking through all this material you sent on Warren Buffett, and, well, something really jumps out.
Oh, yeah? What's that?
It's how everyone calls him this amazing stock picker, but he actually sees himself totally differently.
Yeah.
He says, when investing, we view ourselves as business analysts, not as market analysts, not as macroeconomic analysts, and not even as security analysts.
Right. That quote is key. It's fascinating because his whole philosophy is basically pushing back against, standard financial advice.
He's not chasing trends.
Not at all. No market timing, no big macro bets. It's all about the company itself, its fundamental nature. Now, his ideas fit into about 4 categories, but today, let's really dig into the 3 core business tenets. These are like the first hurdles a company has to clear for him.
Okay, sounds good. Let's break it down. Tenet 1 is the business simple and understandable. Seems basic, but I guess it's fundamental for him.
It really is. It connects directly to his idea of the circle of competence.
Ah, right. The circle of competence.
Yeah. The sources are clear. Your investment success kind of depends on how well you actually understand the business, how it makes money, what makes it tick.
If you don't get it, you can't make smart calls.
Exactly. You can't see the risks or opportunities clearly, and Buffett's advice is clear. Define your circle. Know what's inside, and importantly, what's outside. The size isn't the point.
It's knowing the edges.
Precisely. Knowing where your understanding stops.
But the big criticism there, isn't it? That sticking so strictly to your circle means you miss out on, say, huge tech booms, industries that maybe feel complex.
That's the common critique, yeah. But his response is always about risk management, fundamentally. He argues that, getting rich slowly and avoiding major blunders beats chasing home runs in fields you don't fully grasp.
Avoiding the big mistakes is maybe more important than finding the next unicorn.
That's the idea. It's disciplined. It's about preventing those potentially huge errors that come from operating outside your expertise.
Okay, that makes a lot of sense. And logically, if you need to understand a business deeply, you probably need one that's been around and hasn't, totally reinvented itself every few years. Which leads right into tenet 2, doesn't it?
It does. Does the business have a consistent operating history?
So track record matters a lot.
Immensely. He looks for stability. Businesses that aren't constantly pivoting or undergoing massive reorganizations. It's almost like he's profiting from lack of change, as one source put it.
Interesting phrase. So forget the dramatic turnaround stories.
Generally, yes. He and Munger have said turnarounds seldom turn. It's much easier and often more profitable to step over what they call one-foot hurdles.
Meaning good, solid businesses at fair prices.
Right. Rather than trying to leap over 7-footers, which are these really tough business problems or struggling companies, why make it harder than it needs to be?
Choose the easier path if the returns are there. And the classic example has to be Coca-Cola, right?
Absolutely. Founded way back, selling pretty much the same core thing today. That's consistency.
The core operation is just stable. Predictable, even.
Which then perfectly sets up the third tenet, arguably the most crucial one. Does the business have favorable long-term prospects?
Okay, so simple, consistent, and has a future.
A specific kind of future. This is where the idea of a durable competitive advantage comes in, what Buffett famously calls the moat.
The moat, right? That protects the business like a castle. And this links to his idea of a franchise.
Exactly. A franchise business, in his terms, is one that can earn high returns on the capital it uses because it has a strong moat.
And the sources define that moat or the franchise characteristics pretty clearly. It's three things.
Yeah, three key tests. One, the product or service is needed or desired. Two, it has no close substitute in the customer's mind. And three, it's not subject to price regulation.
Needed, no substitute, not regulated. Why are those three so potent together?
Pricing power. Simple as that. If people need what you sell, can't easily switch, and the government isn't capping your price, you can raise prices to keep up with inflation, maybe even faster. You're protected.
Unlike a commodity business.
Totally different game. Commodity businesses think basic oil, lumber, maybe even some banking services today. They compete almost purely on price. Margins get squeezed, returns are generally lower. A franchise sells something special and can charge for it.
That distinction is crystal clear. And you mentioned a great case study, Justin Industries, boots and bricks. Acme bricks. They sound like commodities.
They could be, but they weren't, not really. They built moats. Take Acme bricks. Yeah, it's a regional brick maker, but they invested heavily in quality and brand, so much so that apparently 75% of Texans specifically named Acme as their preferred brick. They created desire for a brick.
Wow, making a brick desirable.
And Justin Brands did something similar with boots like Tony Lama and Nokona. People didn't just ask for boots, they asked for Justins by name. That's brand power, creating a moat in a pretty low-tech industry.
So wrapping this all up for you listening, Buffett's genius here, it seems, isn't just picking stocks. It's this deep, disciplined analysis of the business itself, defining limits, demanding consistency, and looking for those durable advantages, those moats, even in seemingly boring industries.
Right. He finds great businesses, often simple ones, that are built to last. And that durability, that moat, is everything. So here's something to think about. Look around you at everyday stuff. Maybe paint, maybe some specialized tool, maybe even those boots. Which of these simple products have managed to build that kind of powerful, lasting moat? And how does that quiet consistency actually beat out all the noise and complexity of the fast-changing market? Something to chew on. Welcome to the Deep Dive. Today, we're trying to get inside Warren Buffett's head a bit, figure out what he really demands from management. We're looking at his non-negotiables before he even dives deep into the financials.
Exactly. It's about the people. For Buffett, character is, well, it's everything. He famously said, "We've never succeeded in making a good deal with a bad person." He's looking for managers who are honest, capable, and crucially, think like owners, long-term owners.
Okay, so let's unpack that. You mentioned three core pillars he focuses on, beyond just the profit and loss statement.
That's right. Three key traits. First, there's rationality. Second is candor with shareholders. And third, something he calls resisting the institutional imperative.
All right, let's start with rationality. What does that look like from Buffett's perspective? Is it just smart decision-making?
It's primarily about capital allocation.
Yeah.
That's the manager's #1 job, really, deciding what to do with the company's earnings. The absolute goal has to be increasing long-term shareholder value.
But isn't there a temptation for managers to just, hold on to cash, build their empire? Where's the line?
The line is the cost of capital. It's pretty clear-cut, actually. If management can't reinvest extra cash internally and earn a return higher than that basic hurdle rate, well, then they have a duty to return that money to the owners.
Through dividends or stock buybacks?
Exactly. Dividends or buybacks. Just keeping cash to fund pet projects or make mediocre acquisitions, that's irrational. That's the empire building you mentioned.
And we've seen how powerful rational buybacks can be. Coca-Cola is a huge example, right? They started back in the 80s.
Oh, absolutely. Stunning example. Coke spent, around $12.4 billion buying back over 1 billion shares starting in '84. 10 years later, those shares they bought back, worth roughly $60 billion. That's just pure value creation from rational capital deployment. Owner-like thinking.
Okay, so rationality tests competence with capital. What about the second pillar, candor? That sounds like honesty, but maybe it's more.
It is more. It's about full, genuine reporting. Admitting mistakes, not just trumpeting successes. Buffett has this belief, that a CEO who misleads others in public, well, they might eventually start misleading themselves in private. and that leads to bad decisions.
And Buffett practices this himself, doesn't he? I remember reading about his comments on the General Re merger.
Yes, that's a perfect illustration. In his own letter to shareholders, he was incredibly blunt about it. He admitted he dithered his word in shutting down General Ray's derivatives division quickly enough after they bought the company.
And he actually put a number on it.
He did. He estimated that inaction cost shareholders something like $100 million. That level of self-criticism, in public, that sets the standard he expects.
Wow. Okay, so rationality, candor, and the third one, resisting the institutional imperative. Sounds a bit academic. What's the core idea?
It's really about avoiding herd mentality,
Yeah.
corporate conformity. Buffett calls it the lemming-like tendency. It's when companies just blindly copy their peers, even when it makes no sense.
Like what? What kind of thing?
Oh, you see it all the time. Mindlessly matching executive pay packages just because competitors do. Or launching projects just because there's budget available, not because they're truly good ideas. Or chasing acquisitions just because everyone else seems to be doing deals. It's often irrational.
It must take some courage for a manager to swim against that current. You mentioned Clayton Homes as an example.
A fantastic example. Back when the whole manufactured housing industry was making incredibly risky loans, leading to huge defaults, Clayton Homes stood apart. Their management did something different.
What did they do?
They tied their salespeople's commissions directly to the performance of the loans they wrote. If the loan went bad, the salesperson felt some of the pain. That simple resistance to the industry norm meant their delinquency rate was about half the average. Put them in a great position, strong enough for Berkshire to acquire them.
So looking at management through these three lenses, rationality, candor, resisting the herd, it gives you early warning signs, doesn't it? Long before the numbers might turn sour.
Absolutely. It's insight into the future, in a way. And speaking of warning signs, maybe for a final thought, Buffett has a couple of quick red flags he watches for, things that signal untrustworthy management.
Oh, like what?
First, he says, beware of overly complicated, confusing footnotes in the financial reports.
Right, the thinking being if it's hard to understand, maybe they're trying to hide something.
Exactly. He sees it as a favorite hiding place. And the second red flag, be really suspicious of companies that constantly trumpet specific earnings projections for the future.
Because nobody can really predict the future with that kind of certainty.
Precisely. Buffett's view is simple. No one knows the future. Any manager who claims they do, especially with pinpoint accuracy, probably not someone you can fully trust. Welcome back to the Deep Dive. Today, we are really opening up Warren Buffett's playbook.
Yeah, we are.
Our mission, really, is to cut through all the accounting jargon, the sleight of hand,
Right.
and find those core financial ideas he uses. Judging management, finding real long-term value.
And crucially, looking at averages.
Yeah,
Right, like 4 or 5 year averages, not just the latest quarter.
exactly. Because real value creation, it's rarely neat and tidy like that.
Mm-hmm. So we're chasing the metrics that show, sustainable success. And Buffett's view, it kind of boils down to 4 main things.
Okay, what are they?
Well, first, return on equity for efficiency. Then, calculating what he calls owner earnings, that's the real cash flow. Third, demanding high profit margins consistently.
And the last one.
And finally, proving it all works with the $1 premise.
Okay, let's start with number 1. Efficiency. Return on equity, ROE. Why does Buffett pretty much ignore earnings per share, EPS? He calls it a smokescreen, I think.
He does. It's his savings account idea. Think about it. If a company boosts EPS by 10%, sounds good, right?
Yeah, sounds great.
But what if its equity, its capital base, also grew 10%? Well, then they haven't really done anything spectacular. It's just capital compounding on its own.
Okay, so ROE is the real test, like operating earnings divided by shareholders' equity.
Exactly. That shows how well management is actually using the capital you, the shareholder, gave them.
But you mentioned cleaning up the numbers. How do we do that to get a true picture?
Right, you got to scrub the data. First, the equity part. Any stocks they own, marketable securities. Value them at what they paid, at cost, not current market price.
Okay, why?
Because you don't want stock market ups and downs messing with your measure of the business's performance. You want to isolate management skill, not their luck in the market.
Got it. Isolating operating skill. What about the earnings side, the numerator?
Yeah, for the earnings, you strip out all capital gains or losses and any weird one-off extraordinary items. Just the profit from the main business.
Makes sense.
And crucially, debt matters here. A truly great business gets high ROE without loading up on debt. Look at the Washington Post Company back in the day.
Okay.
They nearly doubled their ROE, got it up to 36.3% by 1988. And at the same time, they slashed their debt-to-equity ratio way down from like
That'll
37% to under 3%.
Wow. Okay, that's impressive. And it leads us to the second principle, real cash flow. If ROE shows efficiency, how do we know the cash is real? Why isn't standard cash flow good enough?
Well, standard cash flow often ignores something huge, especially for, say, manufacturers. Businesses with lots of assets.
Okay.
It leaves out the mandatory spending, the capital expenditures or CapEx that you absolutely need just to keep the business running at the same level, to maintain unit volume.
So like replacing worn-out machines.
Exactly. You can put it off for a bit, make the cash flow look good, but eventually your business suffers. It's a real cost, just like paying salaries. But it often gets missed in that standard cash flow number.
Right. So owner earnings is Buffett's way of forcing us to see that cost. How's it calculated?
You start with net income. Then you add back depreciation and amortization because those aren't actual cash expenses. Then you subtract the CapEx needed to maintain things.
The mandatory stuff.
The mandatory stuff, yeah. And any extra working capital needed just to stay level. He admits it's not, perfectly precise, but he quotes Keynes. I would rather be vaguely right than precisely wrong. And you saw this work with Coca-Cola. Their owner earnings grew like 17.8% compounded through the 80s.
And that translated.
Directly. Their share price growth averaged over 31% a year during that same rough period. Real earnings fueled real returns.
Okay. Efficiency with ROE, real cash with owner earnings. Number 3, high profit margins. This sounds less like a formula, more like company culture.
It absolutely is. It's about management behavior. The best managers, they don't suddenly launch a cost-cutting program when things get tight.
No.
No, they attack costs relentlessly all the time, even when profits are setting records. Buffett says it's like practicing breathing. You just do it.
Like breathing.
Think about Berkshire itself. Their corporate overhead is tiny, less than 1% of operating earnings. That saves shareholders maybe 9% compared to a more typical company setup. It's discipline.
And that discipline pays off. You mentioned the Washington Post again.
Yeah.
Their margins really jumped, didn't they?
Massively. Pre-tax margins went from about 11% in 73 to nearly 32% by 88. Why? Management got tough on costs, especially wages, blew past the industry average.
So that discipline leads to the final test. The proof, maybe. The $1 premise.
Yeah, this is the quick check. The acid test for management's capital allocation skill. It's super simple, really.
Right.
For every single dollar that the company kept earnings, it retained instead of paying out to you.
Right, the reinvested profits.
Did it create at least $1 in market value for the company's stock over time?
So did reinvesting that dollar pay off more than just holding it?
Exactly. If yes, then management has proven they invested that extra capital well. But, and this is key, this only really shows up accurately over long stretches of time. Years, not quarters.
Okay, so pulling this all together, what's the big takeaway for you, the investor listening right now?
You have got to dig deeper than the surface numbers. You need these tools to spot, frankly, the phony numbers, because Buffett warns managers who constantly promise to make the numbers, eventually they might feel pressured to, make up the numbers. Understanding ROE, owner earnings, margins, this $1 test, that's your defense.
That really makes you think. So here's something for you to chew on this week. Look at a company you follow. Think about its cash flow statement. What specific, necessary capital spending stuff needed just to keep the lights on and the machines running might be hidden or deferred in that simple cash flow number everyone quotes? What's the real cost just to stay in the game? Okay, let's get right into it. We're doing a deep dive today, really trying to get inside Warren Buffett's head on value investing.
Yeah, specifically how he thinks about investment guidelines.
Right, and it seems to boil down to separating two really critical things for any investment.
Exactly. First, is the company itself actually a good value, fundamentally?
And second, is the price you're seeing right now, favorable?
It all comes back to that famous Buffett line, doesn't it? Price is what you pay. Value is what you get.
So the goal for a rational investor anyway is simple. Only buy when the price is clearly lower than that per share value.
That's the core principle. Without that gap, there's no investment case, not for him.
Okay, so if price isn't value, how does he figure out that underlying value? What's the method? Is there a formula?
Well, he really stands on the shoulders of John Burr Williams and the dividend discount model concept.
Oh, okay, BDM.
But Buffett adapts it. He's not just looking at dividends. He's calculating the present value of all the future cash an owner can actually pull out of the business.
Owner earnings, that term he uses.
That's the one. Owner earnings. And you discount those future earnings back to today. It's functionally pretty similar to how you'd value a bond, thinking about its future coupon payments.
That bond analogy helps. But hang on, bonds mature, right? A company, you'd be valuing it based on cash flows over its entire life.
Yeah, theoretically, yes. You assume it goes on perpetually.
Doesn't that kind of inflate the value, assuming forever?
It sounds like it might, but the math of discounting takes care of that. Cash flows way out in the future, 20, 30 years out, they become almost worthless in today's terms once you discount them back.
Okay, got it. The discounting handles the forever problem.
Right. The real trick is defining those owner earnings accurately. It's not just the bottom line net income you see on the statement.
What is it then exactly?
Yeah, like a net income plus your non-cash charges like depreciation, but then, and this is crucial, you subtract the maintenance capital expenditures.
The money you have to spend just to keep the business competitive, to keep the doors open.
Precisely. The cash you can actually take home versus the cash needed just to stand still. That's the owner earnings he wants to value.
Makes sense. But projecting that, especially for like a fast-moving tech company, how certain can you be?
And that leads straight to his idea of the circle of competence. It's fundamental.
Meaning?
If he can't project those owner earnings with a high degree of confidence, say 10 or even 20 years out, he just won't do it. He walks away.
Like the famous Microsoft example, right? He admitted he just didn't get the tech industry well enough back then.
Exactly. He couldn't reliably predict its long-term competitive position or cash flows, so no evaluation attempt. Pass.
That discipline is admirable, sure, but passing on Microsoft must have stung later, financially speaking. How do you weigh that? Missing huge growth.
Well, for him, that discipline connects directly to the discount rate he uses.
Okay, how so?
Because if the business is truly predictable, truly within his circle of competence, he argues you don't need to add this extra fudge factor, this equity risk premium that most analysts tack on.
Interesting. So what rate does he use?
He typically looks at a risk-free rate, like the long-term government bond yield. Sometimes when rates were super low, he's apparently used 10% just as a floor, kind of building in an extra margin of safety there.
So the safety isn't in adjusting the discount rate upwards for risk. It's in choosing predictable businesses to begin with.
That's the idea. The quality and predictability of the business is the risk mitigator.
Which brings us neatly to the other safety measure, the margin of safety.
The final piece. And it does two things, really.
Okay.
One, it protects your downside. If you buy cheap enough, even if your value estimate is a bit off or the business stumbles slightly, you're cushioned.
Right, you don't get wiped out by small errors.
And two, it's where the potential for really extraordinary returns comes from. When the market finally wakes up and realizes the true value, that gap closes in your favor.
And we have some great examples in the source material. The Washington Post back in '73, market cap was, what, $80 million?
Yeah, tiny. But Buffett realized the market was basically just valuing the newspaper itself. It was ignoring these incredibly valuable TV and radio station licenses the Post owned.
Hidden assets.
Totally hidden in plain sight. His team figured the real intrinsic value was closer to $400 or $500 million. He bought a huge chunk for less than a quarter of its actual worth.
Incredible. Or Wells Fargo in 1990. Big panic about bad loans in the banking sector.
Yeah, the market was terrified. But Buffett and his team calculated the value, even with those loan concerns, at around $6.6 billion.
And he paid.
About $3 billion, still a massive, 55% discount to their conservative estimate of its value. He saw the fear created the opportunity.
So it's a process. Find predictable companies you understand.
Check. Inside your circle of competence?
Determine their real value using owner earnings and a sensible discount rate.
Check the calculation.
And then you just wait. You wait for some, I don't know, unusual situation, some market panic that pushes the price way below that value.
That's the margin of safety trigger. Simple framework. What to buy, what to ignore, and when to buy. All driven by value versus price.
Okay, wrapping this up then. A final thought for you listening. Buffett insists he won't value a business if he can't predict its future earnings. We've seen him pass on huge tech winners because of that. So thinking about today's landscape AI, maybe crypto, maybe something else entirely, what big dynamic sector do you feel falls outside your own circle of competence right now?
And maybe reflect on how that discipline, that willingness to say, I don't know enough, might actually save you from overpaying when hype outruns reality.
Something to think about. Welcome to the deep dive. So when you hear Warren Buffett, you instantly think stocks, right? Coca-Cola, American Express, those big famous equity plays. Yeah, absolutely. But here's something maybe less obvious from the sources we looked at. Fixed income, bonds, cash, preferred stock. It's actually a huge critical part of the Berkshire Hathaway picture, right? Not just some portfolio filler. A massive piece.
Exactly. We're talking like structurally necessary because of Berkshire's sheer scale. By the early 2000s, it was around, 30% of their capital?
Wow.
So our mission today really is to unpack how Buffett uses those same value investing principles, looking for bargains, that margin of safety, good management, but applies them to debt, just like he does with stocks.
And he almost had to, didn't he? Because Berkshire just got so enormous, finding enough undervalued stocks became, a challenge.
Precisely. It's simple math at that scale. He needed places to deploy billions, especially with all the cash constantly flowing in from their massive insurance operations.
Okay, but he's famously wary of long-term bonds, isn't he?
Oh, avoids them like the plague. He's terrified, maybe too strong a word, but deeply concerned about inflation just eating away purchasing power over decades.
So when he does buy debt,
He's hunting for specific things, shorter-term stuff, or incredibly secure assets. And crucially, he treats that bond or preferred stock almost like buying a whole business, focusing on its steady income.
okay, let's get concrete. That bond is a business idea?
Mm-hmm.
How did that play out with the Washington Public Power Supply System, WPPSS?
Whoops. Yeah. The 1983 default. Biggest municipal bond default in U.S. history at the time. Just total chaos in the market.
Panic everywhere.
Absolute panic. But what's fascinating, and classic Buffett, is how he filtered the noise. He didn't just see one big failure.
He saw a distinction.
A vital legal one between the bonds that really defaulted projects 4 and 5, the speculative ones, and the operational projects 1, 2, and 3.
But wasn't there still huge political risk, legal uncertainty? Seems like a minefield for a value guy.
That's the genius bit. He realized the market was pricing in risk that wasn't really there for those specific bonds. Projects 1, 2, and 3 were direct obligations of the Bonneville Power Administration, basically backed by the federal government. That distinction removed the default risk everyone else was freaking out about.
Okay, so while everyone else ran screaming, the bonds for those projects tank.
Yeah, the lowest coupon ones sank to 40 cents on the dollar. He just swooped in.
And
Generated something like 15 to 17%. Tax-free.
Wow.
He literally calculated his $139 million investment as buying a business earning $22.7 million a year after tax, getting that reliable, tax-free income stream for half the cost of a similar operating company. That's the bond as a business idea in action.
Incredible.
Okay.
Let's shift gears from muni drama to corporate panic. RJR Nabisco. Buffett famously called new high-yield bonds junk before they were issued. Yet, he bought almost $500 million worth of RJR bonds right after that failed UAL buyout in '89. Absolutely cratered the junk bond market. How do we square that?
It's all about that distinction again. He avoids newly issued stuff that's speculative from the get-go. What he looks for are fallen angels.
Like the WPPSS bonds.
Exactly. Bonds that were investment grade but got hammered by temporary market panic. RJR Nabisco still had stable businesses, good cash flow, and they were selling assets to cut debt.
So the market just threw the baby out with the bathwater.
Pretty much. They got lumped in with genuinely toxic debt, unjustly punished in his view. He saw the underlying stability others missed in the panic.
So he bought in cheap, $440 million worth.
And when things calmed down and the bonds were redeemed at full value just a couple of years later, boom, $150 million capital gain for Berkshire. Pure arbitrage on fear.
Okay, so we've seen distressed munis, fallen angel corporates.
Yeah.
What else is in his fixed income toolkit?
The third big one is convertible preferred stock. It's kind of the ultimate hybrid.
Right, because you get that steady income like a bond for downside protection.
High current income usually. But you also get the option to convert into common stock, so capture the equity upside if things go well.
And we see him use this particularly when maybe he's not super confident about the long-term cash flows. He wants that income stream locked in first.
Often, yes. He values the preferred for its fixed income characteristics first. The Mid-American Energy deal in 2000 is a great example. Really complex transaction.
What drove that one?
A big part was trust in the management, Walter Scott, David Sokol, high-integrity guys. But the value proposition was anchored by the high return on the preferred shares. He even committed billions more to support their growth, like for pipelines.
So he got downside protection and massive eventual upside.
Exactly. Fixed income security, equity potential.
So wrapping this up, what's the big takeaway for you listening to this? I think it's that Buffett's genius isn't really tied to stocks or bonds specifically. It's the universal application of that core value principle. Buy something for way less than it's truly worth, whether that worth comes from dividends, income streams, assets. It doesn't matter. Find the value, buy it cheap, wait.
And it worked. I mean, his big move into fixed income around 2002, 2003, highly profitable. The sources mentioned realized gains hitting $2.7 billion in 2003 alone.
Incredible. Okay, here's a final thought to leave you with, something Buffett himself apparently said after the WPPSS success. He hoped he'd run into some other large stigmatized issue.
Makes you think.
Yeah. The biggest bargains, the greatest value. Maybe it's not in the popular stuff. Maybe it's in those huge, messy, embarrassing situations where everyone else is just running scared. That's where the true value investor needs to be willing to look.
Okay, so we've spent a good bit of time digging into how to pick great companies, using Buffett's ideas.
Right, it's the selection part.
Yeah.
Choosing the right
Yeah.
businesses.
Exactly. But buying them, that's like only half of it, isn't it?
Oh, absolutely. Maybe less than half sometimes.
The other half, maybe the harder half, is actually managing the portfolio, surviving that emotional roller coaster that comes with investing.
Yeah, it's that classic image problem. You think money manager, you picture, I know, someone frantic, right, glued to screens, yelling.
Totally. Panicked by every little tick up or down.
But Buffett, he's the absolute opposite. Calm, thinking in years, even decades, not minutes.
And the key to that calm, the way he tunes out the noise, is this strategy he calls focus investing.
And to really get why it's different, you kind of have to look at what most other people do, the status quo.
Which is usually one of two things.
Pretty much. First, you've got active portfolio management, constant trading, buying, selling, trying to guess the next 6 months.
Always trying to bit the market, time the peaks and troughs.
Yeah, but the whole idea is, well, it's built on sand, really.
Yeah.
Predicting the short term is basically impossible.
Plus, all that trading costs a fortune in fees and taxes.
It does. And the data backs it up.
Yeah.
I mean, back in '98, something like 90% of those active funds were doing worse than the plain old S&P 500 index.
Wow, 90%. Okay, so that leads to the second option people take.
Exactly. Index investing.
Oh.
Totally passive. You just buy a fund that mirrors the market like the S&P 500, and you just hold it.
Buy and hold. Low cost.
Super low cost. And the upside is you're guaranteed the market return minus tiny fees. You can't do worse than average.
But you can't do better either.
Precisely. Buffett even said, the know-nothing investor. His words can often beat the pros just by indexing and avoiding all his active trading mistakes.
Okay, so active trading often fails. Indexing gives you average. But Buffett aims above average, so how does he do it? Back to focus investing.
Right. Focus investing. The third way, you could say?
So what is it, fundamentally?
It's simple in concept, but hard in practice. You pick just a few companies. Really outstanding ones you understand well.
A few, not dozens.
Nope, a few. And you put a significant chunk of your money into those few. You concentrate your bets.
Okay, concentrate, and then...
And then you hold on through thick and thin. You ignore the short-term price swings because you're betting on the long-term business performance.
That sounds intense. And definitely not like the usual advice about diversification. What are the sort of ground rules for this concentration?
Yeah, it's definitely not typical advice. The rules are pretty clear, though. First, really focus only on outstanding companies. Second, limit how many you own.
How many is few?
Maybe 10 to 20 stocks is a good range. More than 20 starts to get problematic. Dilutes the focus.
Okay, 10 to 20. And the betting part.
You have to bet big when you have high conviction. Buffett thinks if you're really sure about an investment, you should be willing to put, say, at least 10% of your net worth into it.
10% in one stock. That feels aggressive.
It requires conviction. Think about his American Express investment during that salad oil scandal. The stock tanked.
Right, huge crisis for them.
And he put 40% of his partnership's money into it. 40.
Wow, okay, that's serious conviction. It paid off though, right?
Massively. Made something like $20 million. But the point is, you need that conviction.
Yeah.
And you need time. The goal is low turnover, maybe 10, 20% a year.
Meaning you plan to hold for 5, maybe 10 years? Or longer?
Ideally, yeah. Which brings us to where this whole philosophy just clashes head-on with traditional finance theory.
Modern portfolio theory, MPT.
Exactly. MPT, Markowitz, Sharpe, their whole definition of risk is different.
They define risk as volatility, right? How much the share price bounces around.
Price swings equal risk. But for Buffett, risk isn't the price moving. Risk is the chance of losing your money permanently because you misjudge the business itself. its value, its future earnings.
So if a great company's stock price drops hard,
For Buffett, that often reduces the risk because you can buy it cheaper. It's an opportunity, not a disaster. Totally flips the MPT view.
which must change how he views diversification, too. MPT says diversify widely to reduce that price volatility.
Right. Spread your bets thin. But Buffett famously said, diversification serves as protection against ignorance.
Huh. Okay, so what's his alternative?
Concentration. He argues it decreases risk because it forces you to know your few companies inside and out. You do intense research.
Less ignorance, less need for broad diversification.
Precisely. It's why he finds things like the efficient market theory kind of funny. The idea that all information is already in the price, so you can't get an edge.
Yeah, that theory suggests deep analysis is pointless.
And Buffett says basically, great, keep teaching that. He thinks it helps his followers because it discourages competitors from doing the hard analytical work.
Okay, so it comes down to intense research on a few things, betting big, and then patience, inactivity, really.
Huge amounts of patience. His ideal holding period, he says it's forever.
Forever. As long as the company stays great.
As long as the business economics remain superior and management acts rationally, yeah, just hold on.
And there are big financial benefits to just sitting tight, besides avoiding trading costs.
Oh, enormous benefits, especially after taxes.
Sure.
He calls it getting an interest-free loan from the Treasury.
How does that work? The tax angle.
Think about it. If you have, say, a $1 investment that doubles every year for 20 years, if you sell and pay capital gains tax every year, your final amount is way, way lower.
Right, the tax drag compounds against you.
Exactly. But if you hold that same investment for all 20 years, let the gains compound tax deferred, and only pay tax once at the very end.
The difference must be huge. All those years of compounding on money that would have otherwise gone to taxes.
Astronomical difference.
Sure.
It dramatically boosts your after-tax return.
Yeah.
That inactivity, that tax deferral, is incredibly powerful.
So the potential results are amazing, but it really comes back to handling the ride, doesn't it? Focus investing means your portfolio will be more volatile than the market. It'll be bumpier.
Absolutely. That's the price of admission for potentially higher returns. You have to be able to stomach those swings without panicking.
And the proof is in the pudding, looking at his disciples, the super investors.
Yeah. Look at Munger, Ruane, Simpson guys who follow this closely. Incredible long-term records, beating the market significantly. But if you dig into their year-by-year results, they all had rough patches. Munger underperformed the market for 3 years straight at one point. Ruane had 4 consecutive years of underperformance.
Wow. So even the best using this method went through long periods where it looked like it wasn't working.
Exactly. It proves the strategy can work over the long haul, but only if you have the guts, the temperament, to stick with it when it feels terrible.
So the real challenge isn't just finding the great company.
No, the real challenge is mastering your own emotions. It's self-control when your portfolio is down and everyone else seems to be winning. That's the hardest part. Welcome to the deep dive. You know, if you think investing is all cool logic and numbers, well, our sources suggest you might be missing the real story.
That's exactly right. It seems investing is actually driven by behavior that's, well, erratic, contradictory, often pretty illogical.
So today we're really digging into the psychology of money, trying to understand why investors, even really smart ones, make these, let's say, questionable decisions.
Yeah, it's a field often called behavioral finance. And it really boils down to two very powerful emotions, fear and greed. They seem to push prices around way more than, company performance sometimes.
Okay, let's unpack that. Warren Buffett famously said success in investing doesn't really correlate with IQ once you get past a certain point, like 125. So if it's not pure brain power, what is it?
It's temperament. That's the key. It's having the emotional control to resist the urges that trip up almost everyone else.
Temperament.
Mm-hmm. Ben Graham, who was basically the father of value investing, he broke it down into 3 key traits for a real investor. First one, calmness.
Calmness. Like staying cool when the market crashes.
Exactly. Reacting with equanimity. Buffett's really blunt about this. He says if you can't stand seeing your stocks drop by 50% without panicking, you just shouldn't be in stocks at all.
Wow, 50%. That takes serious nerve. And it must be tough resisting the opposite too, right? Like when everyone's euphoric in a bull market, the sort of mob influence.
Absolutely. And that leads straight into Graham's second trait, patience. You have to be willing to say no far more often than you say yes.
Okay.
Buffett has this great analogy. Imagine you get a punch card for your whole life, but it only has 20 punches on it for investment decisions.
20. That's it.
That's it.
Yeah.
So that forces you, or it should force you, to wait for the truly outstanding opportunities, not just constantly tinkering.
That kind of discipline, always fighting the urge to just do something. That must tie into the third trait, which you mentioned was rationality.
Precisely. Being rational means not getting too gloomy when things look bad, but maybe even harder, not getting swept up in irrational optimism when everyone else is.
So it's that classic Buffett line, be fearful when others are greedy.
And greedy only when others are fearful.
Right. Optimism feels good, but it can be the absolute enemy of making a rational purchase.
Graham had a really vivid way to illustrate this whole emotional battle, didn't he? He created a character, Mr. Market.
Yeah, Mr. Market. Think of him as your business partner, but he's, well, emotionally unstable, bipolar maybe.
Yeah.
Every day he comes to you and names a price.
A price for what?
A price he's willing to buy your share of the business for, or the price he'll sell you his share for. And his mood dictates the price. Sometimes he's wildly optimistic, quoting a crazy high number.
And other times.
Other times he's deeply depressed, offering a ridiculously low price. Total panic.
So the lesson is, use his offers when they're silly, but don't ever let his mood swings affect your own judgment.
Exactly. Take advantage of his pocketbook, but ignore his wisdom. Graham even said, an investor who gets easily spooked by market dips would probably be better off if their stocks had no market price quoted at all, because then they wouldn't be tempted to react to the daily noise.
Right. No temptation, no irrational short-term moves.
Okay, that's the big picture. But let's touch on some specific traps behavioral finance has identified, these cognitive biases, like overconfidence.
Oh, yeah. That's a big one. People consistently think they're better than average. Like that study with doctors, 90% confident in their diagnoses, but only actually right about 50% of the time.
Ouch. And overconfident investors.
They trade too much, usually at the wrong times. They think they know more than they do.
And that connects to another bias, right? Overreaction or myopia, like being nearsighted.
Tend to put way too much weight on recent short-term stuff. There was this study, fascinating, they showed students stock returns. Some saw volatile monthly data, others saw smoother 5-year data.
Okay.
The ones who saw the monthly volatility, they only put about 40% into stocks. The ones who saw the long-term picture put almost 70% in.
So the advice is basically buy stocks and then, don't look.
Pretty much. Or as someone put it, invest in equities and then don't open the mail. Avoid the short-term noise.
Okay, then there's the one that feels really visceral. Loss aversion.
Yes. The pain of losing feels roughly twice as bad as the pleasure of an equal gain. It's a powerful asymmetry.
And that makes us too cautious.
Yeah.
Or makes us hold on to losing stocks too long because selling means facing the failure.
Both, really. It makes us irrationally conservative sometimes, and yeah, it makes it hard to admit a mistake and cut our losses.
One more mental accounting. This one's kind of weird.
It is. We treat money differently depending on where we think it came from. Finding $50 in an old coat pocket.
Yeah.
You might just blow it on something frivolous, right? You wouldn't treat $50 you just earned from your paycheck the same way, even though it's the same $50.
Huh. So we assign different risk levels based on the money's story.
Exactly. Irrational, but we all kind of do it.
So wrapping this up, what's the big advantage of understanding all this psychology?
Well, two things, really. First, you get some clear guidelines, some guardrails to help you avoid these really common emotional mistakes.
And second,
you start to recognize these mistakes when other people are making them. And that sometimes can create opportunities.
because the road to investment success is, as you said, bumpy and often counterintuitive.
Always. It's rarely a smooth ride.
So the final thought for you to mull over. The real challenge isn't necessarily being smarter than everyone else. It's about being more disciplined. It's about controlling those primal urges of fear and greed.
Every time you think about buying or selling, just ask, is this logic talking? Or is that Mr. Market whispering temptations in my ear?
Welcome to the deep dive. We're digging into Warren Buffett today, maybe the ultimate financial outsider, through this great George Bernard Shaw quote.
Oh, the one about the reasonable man.
Exactly.
Yeah.
The reasonable man adapts himself to the world. The unreasonable one persists in trying to adapt the world to himself.
Therefore, all progress depends on the unreasonable man. Yeah, that fits Buffett perfectly.
It really does. Because while, the so-called reasonable folks were chasing trends.
Right, getting tangled in program trading in the 80s or completely wiped out in the dot-com bubble.
Buffett just kept compounding, Steady, superior results. It looks almost simple from the outside.
Well, it is simple in concept, but it runs counter to almost everything else you see on Wall Street.
Which is the big question we're tackling. If it's so sensible, why don't more investors actually do it?
Because fundamentally, they're playing a different game. The
Yeah.
typical manager is focused on activity, on predicting stock prices.
Watching tickers, reacting to news.
Exactly. And they get immersed in all this academic stuff, CAPM, beta, modern portfolio theory.
Which sounds impressive, but what's the problem with that approach, really?
The big problem. They define risk as volatility. You know, the stock price bouncing around. That's their main focus.
Okay.
But Buffett, he barely looks at the price initially. He's looking at the business underneath. Is it generating cash? How's the management?
He has that quote, doesn't he? Something about fish and land.
Yeah, can you really explain to a fish what it's like to walk on land? His point is, actually running a business, even for a day, gives you a perspective that just, well, watching stock quotes never will.
Okay, so let's get practical. If he ignores the day-to-day price madness, how does he track if things are going well? What's his yardstick?
He looks at the business's actual performance year by year, not the stock price.
Like what specifically?
Things like the return on the equity the company started the year with, are operating margins improving? That shows pricing power. Is debt going up or down? How much cash does the business actually throw off after reinvestment?
So it's all about the underlying economics, if those are good.
The long-term price eventually has to catch up. The short-term swoops, as he calls them, are just noise.
Which leads straight into his first, maybe most famous piece of advice. Turn off the stock market. Easier said than done, though.
Oh, absolutely. But the key is how you view it. He sees the market as this manic, depressive character.
Moody, unreliable.
Exactly. You don't take instructions from it. You just check in occasionally to see if it's, in his words, offering to do anything foolish.
Like selling you a great company way too cheap.
Precisely. He didn't need a daily quote on Coke back then to know it was a good business, right?
Yeah.
The market's a tool, not a guide.
Okay, step 1. Ignore the market's moods. Step 2 sounds just as contrarian. Don't worry about the economy.
Yeah, another tough one for people whose jobs often involve predicting the economy.
Right. How can you invest without an economic outlook?
Because predicting the economy is, well, largely a waste of time. You'll be wrong more often than right.
So instead,
Find a business that's so good it can make decent money regardless of the overall economy. Whether it's booming or busting, that's the goal. Much harder, but way more reliable.
that flows into step 3. Buy a business, not a stock. You're saying the price tag is almost the last thing he looks at.
Pretty much the last step. Before you even think about price, the business has to clear some serious hurdles.
Like what?
It has to be simple, something you can actually understand, run by managers who are both honest and good at their jobs. And critically, it needs to have favorable long-term economics.
Only then do you look at the price.
Only then. And you compare that price to your estimate of its real underlying value, its intrinsic value. And even then, you don't buy unless you get it at a significant discount.
The margin of safety.
The margin of safety, that's your protection against being wrong.
Okay, final step. Manage a portfolio of businesses. This one surprised me. He favors concentration, not diversification.
Yeah.
Isn't that risky?
Well, he'd say wide diversification is mostly for investors who know nothing, his words. People who haven't done the deep homework on individual companies.
So for them, an index fund is fine.
Absolutely. But if you have done the work, if you really understand a few businesses deeply, why put your money in your 20th best idea?
Instead of putting more into your absolute best idea.
Exactly. Focus your bets on your highest convictions. It makes sense if you truly see them as businesses you partly own.
It's fascinating. The whole approach, it's not about complex formulas.
Not at all. He always says it is just not necessary to do extraordinary things to get extraordinary results. The complexity comes from everyone else playing a different, harder, often losing game.
So success isn't just about picking winners.
It's just as much about eliminating the things you're likely to get wrong, like trying to predict the market day to day or guess the economy or trade based on price action.
Focus on what you can know, which is the value of a specific business.
Right. Get that part right, demand a discount, and then, well, then you just have to be patient.
So the final thought is maybe this seemingly unreasonable path, it's actually there for you if you're willing to do the homework and, crucially, think for yourself.